Actually, good afternoon, I do apologise. The set of circumstances that led me to be here were kind of unusual. Through a mutual friend, I met the ferociously intelligent Murdo MacDonald, who gave me a couple of papers he'd written which were way above my IQ level. But he seemed to think that one or two of the things I said about finance were resonated with what the work he'd been doing. The credentials are for being here. I'm not a banker. I don't lend money for a living. My organisation doesn't do that either. I'm just going to give you a wee introduction as to what we do, so that will help you calibrate what you're hearing and work out, if you like, where it comes from. And then I hope that that's somehow useful. In my own mind, the way I've summarised this is that I suppose what Murdo was asking me to do from the world of finance was to try and explain to the established Church of Scotland how we came to have established banks in Scotland. That was meant to be a joke, I do apologise. I'm quite so flat on you, but I know your relationship with the state is a different one. And if I may just say, from the outside looking in, obviously the role that what was the Church and Nation Committee, even I know about that, and the role of the Assembly, to the extent that this remotely helps you as you are thinking about some of these extremely vexed issues, then I hope that's useful. One of the great mid-20th century innovations, it happened in a little part before, but it really took off after World War II, was the provision of retirement pensions in what you might roughly call the developed world. And obviously we have them here today, and many of you will know people who are in receipt of a pension. Now, they come in two flavours. I won't bore you with the details, but the great post-war employers, let's say the National Coal Board or British Telecom or so on, when you have 20, 30, 40, 100,000 employees, and they're all paid somewhere around the national average wage, if you take from their pay packet or contribute in addition to that, say, a sum of money equivalent to 15% of that person's salary, and you say to that person, you can't touch that while you're working, because we're saving it up and investing it so that when you retire, you can enjoy a pension. Well, that creates enormous pools of savings, colossal pools of savings, so that some of you might think something like Standard Life's quite big, and it is, but there are plenty of organisations that are much, much bigger. I think I'm right in saying that the Royal Mail pension scheme here in the UK, for example, is over £20 billion in size. Now that's just one measurement of it, because you could measure it by its future liabilities, you could measure it by its income. There's lots of ways to look at it. But these enormous pools of savings had to invest in something. And they've invested in bonds from the government, they've invested in property, they've invested in all kinds of things, but most of them wound up investing most of their money in equity shares of listed public companies, the ones that you see at the back of the FT or in the Scotsman or the Press and Journal or the Crises. And that's what we do for a living. So what we do is we get contracts from our clients to have a discretionary authority to build portfolios for them that have the intent of financing those liabilities for the long term. What that means is that we get to pick and choose, and forgive me, this is not a moment of hubris, but you just need to know this. We actually came through the credit crunch quite well because we didn't own any bank shares. And we did that because we thought it wasn't hard to see what was coming. The scale of it, the cataclysmic implications of it, were very difficult to see. And so that's the background. Just a few points about how we got here. This is not intended to be exhaustive, but I have a reasonable hope that by the time we're finished, you'll have a bit more of a knitted together perspective on how we got here. So one slide at the beginning, and one at the end that is text-based, and then a few in between that are numerical. Forgive me, I'm just going to go into my notes here. Get this together. The first thing, and looking around the audience, I think I'm in reasonably safe terrain to say this. The last colossal financial crisis that we had was really the 1970s. Some of you may think that 87 was bad or 1991, but the last dreadful one was the 1970s. And it was really marked by an inflationary pressure. And we can debate at length the role of OPEC, the role of the Iron and Steel Trades Confederation and the National Union of Mine Workers and the Keynesian economics of Wilson and Callaghan and Heath's governments. We can debate all of that till the cows come home. But the plain vanilla fact was that by 1979, the population of this country and many other Western democracies, the population of this country was ready to elect politicians who purported to have an answer to inflation. Now those answers all around the world varied in detail, but they had as a common core a monetary response to inflation. Now at its crudest, that monetary response was, we will jack interest rates up as high as it takes to squeeze inflation out of the system. Now, I'm no economic historian, and I think the great history of that era has yet to be written, but you'd have to say they were broadly successful. Because at the end of the 1970s, inflation, I think, in this country peaked at 15 or 16%, and interest rates certainly peaked at a higher level. But what that meant was that in this generation that we've lived through, this 30-year, 40-year cycle, we've lived through a period when interest rates have generally gone down. If I can quote you one example, we don't live off gold anymore. We don't have a gold standard to anchor our monetary policy around the world. So people need a baseline, a benchmark against which they can value and assess the risk or reward in any financial transaction. And by common consent, 10-year bonds issued by the US government carry out that role. So what it says is, if you think of it this way, that it's the biggest economy, it's got the 7th fleet, it's got all the power in the world, it's got all, the dollar is accepted everywhere. If you know the interest rate in a US 10-year treasury, you can then work out whether I should lend you a mortgage at more than that. Is your credit rating better than the US government's? So it acts as a sort of benchmark, like an absolute zero or a 0 degrees Celsius that you can benchmark things around. Well, US treasuries, back in 1980, the interest rate was 16%. And at the bottom, a month or two ago, or a few months ago, they got down to 3. Now what that means is, if you were borrowing £100,000 in 1980, you paid 16% for it. If you're borrowing it now, you paid 3. And trust me, it was a pretty gentle line. The mathematicians among you could regress that back to a pretty smooth decline. It's a bit like a blue run up the hill there. That, you know, not too many moguls, you would get down to the bottom pretty easily. The trouble with it is, people get used to those conditions. They get used to interest rates trending down. They get used to Maggie Thatcher and Geoffrey Howe going to war on inflation, and Nigel Lawson saying the same thing. And Jordan, remember the big debates during the ERM? It was all about how do we control inflation. And Brown and Blair, and with that vivid picture the morning after Brown was elected, going straight to the Bank of England and saying, you can set interest rates because the Labour Party was not considered credible. Whether, actually, it's an interesting question, whether the Labour Party was credible, whether Gordon Brown thought the Labour Party was credible at setting interest rate policy. And so you couldn't get elected without being macho on inflation and macho on interest rates, and that meant that we've had a long, long period. So what we've had is, that success has contributed, in my opinion, mightily to the excess of the last few years. So it's not down to the malice of an individual, or the failure of a compensation committee, or a risk management committee. You simply couldn't have the kind of crisis that we are undergoing were it not for those conditions.